You're now tuned in to the Desire to Trade podcast, a show where we bring you the best figures of the trading world and teach you how you can become a successful trader. This is your host, Etienne Cret.
Hey, what's up, traders? It's Khati from the Desire to Trade, and welcome to episode 42 of the Desire to Trade podcast. Today, my guest, Richard Weissman, wrote a book with, I think, the best title ever for a book, Trade Like a Casino. This book talks about how to trade like casino do, basically. That means having a strategy with rules, and then executing on that correctly, like a casino would do. He shared great advice on how you can trade yourself like a casino, how you can implement this in your trading. So this is something not to miss. Now guys, before we go into the interview, I just want to talk about something I've been working on in the past few months, and I just released it. I won't tell you exactly what it is, but go check out thisartrade.com/new, and you'll see everything, new, N-E-W, and you'll see everything I'm talking about. thisartrade.com/new, and you'll see exactly what I've been working on and how you can register. The registration for that are going to be open until Wednesday this week, so make sure you check this out before. Now, last thing, if you're not in the Facebook group, check out thisartrade.com/group and join me there. I look forward to helping you in your trading, and I'll see you at the end. Ciao. We'll start by asking you for one quote that inspires you.
Okay, so one of my favorite quotes from the book is, trade the markets, not the money. So a problem in human nature is that we tend to focus on the money. The only reason why anyone gets in the business of trading is to make money, and it's logical to think about a numerical goal when we're trading because our bills come in a nice, orderly monthly fashion. But returns in the market tend to be quite lumpy. So sometimes the market will give you a few $100s off of a trade, and really that's all that it's offering. And if you try and force more money out of the market from that trade, you're going to lose tens of thousands. Other times, the market will offer us hundreds of thousands off of a single trade. And if you start thinking about your bills and start thinking about the money and wow, this is $20,000. I could pay a lot of bills with $20,000. Then you cut off the profit tail of the distribution, and you cut yourself off from the possibility of an outlier gain.
Sounds good. So what exactly are you doing these days?
So we actually just launched a commodity trading advisor. We just got approval with the CFTC and the NFA to start managing accounts, and we've got I've got a very long trading history, but we've actually just gotten registered. So we'll see. It's an interesting opportunity, and people have asked me to manage money for a long time, and I've always kind of shied away from it. But I've got a couple of partners now. They're going to handle operations and sales and all that stuff for me, and kind of make it a lot easier for me.
So you're really focusing on trading, right?
Yeah. So it's called CNV Capital Management. CNV is in one of the chapters in my book is called The Cyclical Nature of Volatility. And so that's what we're doing. We're trading based upon the cyclical nature of volatility. So volatility cycles from periods of high volatility to low volatility to high volatility. And it actually offers some good potential asymmetries in terms of risk reward, where if you're in low volatility especially, of course it can remain in low volatility and then you'll be looking for a breakout and you end up with a small loss. But the other possibility is that you cycle out of low volatility into high volatility, and then you have the potential for high reward. So that's the type of thing we look for is high probability, because the longer you stay in a low volatility environment, the greater the probability of cycling out of low volatility. With low risk, so if it's a false breakout, it's low risk, you lose little, and the potential for high reward when you have a real breakout.
So we'll definitely talk about your book because there's a lot of stuff in it. But before, I want to know, how did you start to trade exactly?
All right. So I started in '87 on the floor of the New York Futures Exchange, it was called at the time. It was acquired by the Cotton Exchange and then merged to become the NYBOT, the New York Board of Trade, and then that was acquired by Intercontinental Exchange. But when I started, it was trading stock index futures in 1987.
How was the process to learn?
Well, basically, on floor, there's a couple of different types of business models. There's floor brokers or pit brokers. Those are people that are just making commissions, filling tickets for customers. And I knew I didn't want to do that. And then there's scalpers. And basically, they're just trying to make the spread between the bid and the ask all day long and provide liquidity to the market. And I knew I didn't want to do that. So that kind of left door number 3, which was speculation. And that's basically taking a position in order to provide liquidity to other players in the market as well as commercial hedgers. And the problem is that business really doesn't come with with an instructor's manual. So what I had to do was learn through mistakes, and I started learning and losing and learned how to lose less and struggled for not just my time on the floor, but for many years before I actually started developing positive expectancy models that made money over time and managing risk well and eventually, becoming more successful.
I guess every trader goes through that phase, right? So tell us about one mistake you made in that time.
So, well, it's all ancient history. There's so many mistakes. But I guess, one of the most obvious mistakes was that it was a timing mistake. I had entered the business right before the '87 crash. And I kind of knew that the crash was coming. It was one of these things that was kind of obvious. The Friday before the crash was a big down day, and I knew that the crash was coming, and I knew that I should sell S&P. I'm sorry, Knife futures. Knife was our exchange, the New York Futures Exchange, stock index futures. But honestly, I was afraid. I was afraid, it's so big and it was so volatile on Friday. And what if I was wrong? So instead of selling the stock index futures, I bought some gold futures. And of course, gold went up. It's not like I lost money on the trade. But if I had more experience and a greater understanding of market behavior, I would have sold the S&P, I would have sold the stock index futures and done much better.
Mm-hmm. And did you have anyone with you to teach you how to trade, or did you have to learn everything by yourself?
Nope, I learned everything by myself. I read some books, but really I learned by losing money. That's the way you learn. I wish I could say there was another way to learn, but.
And then how did you came to write your book, Trade Like a Casino?
So basically, I had already written a book before that called Mechanical Trading Systems, and I had a relationship with my publisher, John Wiley. And I wrote the book. It was okay. It wasn't a terrible book. It said something. It definitely had something to say, but I did not feel like it was my definitive statement on trading. And that feeling kind of stuck in my craw for, I don't know, close to 10 years. And finally, I approached John Wiley again and said, hey, I got this other idea for a book, and this is the book that I want to write. And of course, because I had a relationship with them, they were happy to publish whatever I was writing. And that became Trade Like a Casino, and it is kind of like my definitive statement on speculative trading, and I'm much more happy with it. It received, critical industry complaint. It received critical industry praise, and it's been a good kind of statement.
Mm-hmm. And just for the listeners, tell us what is the the meaning behind trading like a casino exactly?
So the idea is, like I said, trading, speculative trading doesn't come with an instruction manual. But if you think about what successful speculative trading is, it is what I call the casino paradigm. So the book is divided into three parts, and part one is the casino paradigm. And so it is the world of speculative trading really is like the gaming industry. So in the gaming industry, the casino really doesn't know on any given hand or any given spin of the wheel if they're going to win or lose. That's okay because they have what's known as the probability skew. In other words, if people keep playing these games, probability is skewed in favor of the casino and against them, the player. And that's called the probability skew. And in trading, we call probability skew, most traders call it their edge. But in financial mathematics, we call it a positive expectancy model. It means that after deducting for commissions and the spread between the bid and the ask, you still make money by trading that model. But even in the gaming industry, probability skew is not enough. If you have a player and you allow them to bet too big on a single spin of the wheel and the spin comes up with a low probability event, let's say that they put all their money on black and you allow them to bet $1 billion on a single spin and it does come up black, well, now they own the casino because you've allowed them to bet too big. So what the casinos do is they instill what are known as table limits. And by creating a maximum bet size per spin, it forces the player to bet smaller and ensures that if they play long enough, the probability skew will eat up whatever money they've got. Now, the third element that casinos don't need is, trader psychology, trader discipline, because they've already got the discipline. They've already got that. But we in the world of trading need the discipline to keep betting on the positive expectancy model, keep managing the risk, just like the casinos keep instilling table limits, even after the player has a string of wins. So that's how it works.
So I really like the concept of a casino, basically, because it's really about that. And I think probably the most important point is that you have to keep your money for a long time, right?
Right.
And this is what you mentioned in the book. So tell us, how do people reach that state of trading like a casino exactly?
So I think first thing comes from doing the research on your models. You have confidence in the models because you do tons of research. So you know how bad the worst peak to valley drawdown in equity is because you've tested it for 10, 20, 30 years of data on, 30, 40 different assets that have, low correlation to each other. So that the fact that you know the data, you know that it has positive expectancy over a long data set for low correlated assets gives you the confidence to keep being disciplined and keep managing the risk.
Mm-hmm. So in other words, you have to do the test, right? You have
to back test. Yeah, that's the tricky thing about not doing a mechanical system is that you don't have back tested data supporting your assumptions, and therefore you have no confidence when you have 4 or 5 losses in a row. You have no confidence that your assumptions actually enjoy positive expectancy. So it's tougher.
Mm-hmm. And how would you define like a mechanical system?
Well, a mechanical system could be incredibly simple. Whenever the 50-day moving average crosses above the 200, you buy. And whenever it crosses below, you sell. That's a mechanical trading system. It's rule-based. You can back test it. Everyone throughout the globe, as long as they use the same kind of moving averages, let's just say simple weighted moving averages, and the same assets, they're going to get the same exact back-tested results that you get.
So can discretionary trader use the same methodology of trading like a casino, or is that a different world?
So discretionary traders, you can use like fundamental information in order to come up with trading decisions. You have to somehow Well, there's two things. You can be totally discretionary where there's absolutely no rules, or you can create rules based upon fundamentals, and then there's some kind of discretion as to how you implement it, et cetera, et cetera. But it does become kind of more fuzzy. When I work with discretionary traders, one of the main things that I focus on with them is risk management, money management, because if you're not going to be able to backtest, then the only thing that's going to give you the confidence is that you're a really, really good risk manager. So in other words, you have 5 losses in a row and you're willing to pull the trigger on the 6th trade because you've been trading so small all along that you don't care if you have another loss.
So what are the main mistakes you see people make that you work with?
Number one mistake is that they're undercapitalized.
Okay, so what do you mean exactly?
If think of it this way, let's say that you have $5,000 in an account, right? Okay, and let's say that the commissions per trade is $10. Okay, and that every time you enter or exit, you're probably going to lose another $10. So you can see already, just from the get-go, that you're down almost 0.5% before you ever get started, right?
Okay.
So that's the problem with being undercapitalized, is that it's possible to make money, but you have to be even better, even more perfect. And then what people tend to do because they're so undercapitalized is that they tend to bet too big. They don't manage the risk. So they say, well, look, if I only risk 1% on a $5,000 account, I'm not going to make any money. I'm only going to be risking $50. So I'm only going to be making, let's say, 50, 75, $100. And it's not worth it. So what I'll do is I'll risk 10%, and then I can make $1,000. But the problem is, if you risk 10% and you lose, now you've lost $1,000. Now you got to try and trade with $4,000 under management, and the problem is magnified. And you always have to assume the worst thing is going to happen in your trading right from the get-go at all times. So you assume that immediately upon starting to trade, you're going to experience a drawdown in equity, which is worse than the worst historical drawdown you experienced in your backtest. So if the worst historical drawdown was 10%, you've got to expect that you're going to experience 12, 13, 14%.
That's interesting, though. So what would be the rule of thumb of the money people need to start to trade? Is there like an amount people need, or?
Yeah, I think that, in order to do anything, even a small account, you really need $100,000.
Okay, for stocks, or?
I don't do stocks. I only do futures.
Okay, futures. Okay.
Yeah. So unfortunately, I don't know any. I mean, I know about stock index futures, but I don't trade individual stocks, so I don't feel like I'm qualified to speak on that.
Yeah, so I feel it's going to be different depending on market, right? So even if you're trading currencies, it's probably going to be a different thing.
Now, currencies are very similar to futures. So I will talk. I've traded spot Forex for years.
Okay. And so how was that spot Forex?
It's very similar to futures. Same leverage issues, same problem of being undercapitalized. You don't want to be undercapitalized. I would say to trade spot Forex, you really need $100,000 in an account too, just like futures. You could do it with less, but of course, if you have a drawdown, which you have to assume is going to happen right from the get-go, you could very quickly, be behind the 8 ball and dig yourself a hole that's going to be hard to get out of.
Unless you're ready to accept like a small return, right?
Right. Unless if you're okay with, so let's say, 50,000 in an account. So you're okay with risking 500 to make 500, risking 250 to make 250, then sure, you can slowly, gradually build yourself up.
And about trading like a casino, how is the book made exactly? What's in the book?
So the book is basically divided into three parts. So in part one, it's the casino paradigm, which I've kind of outlined for your listeners already. And so that's, positive expectancy models combined with risk management and trader discipline to keep betting on the positive expectancy models when the losses come in clusters. And then part two is tools and techniques, and then part three is trader psychology, trader discipline.
Mm-hmm. This is something people wonder a lot about, trading psychology and discipline. What are some of the techniques you can use to be more disciplined? This is something I get all the time.
Mm-hmm. To be more disciplined,
yeah.
First thing that gives you confidence, like I said, is to backtest.
Yeah.
Second thing is not to trade too big. If you trade small enough, you really don't care if the next trade is a win or a loss. Second thing is, or the third thing is that you should always know your exit prior to entry. So you should always know why you get in a trade, but also you should know where you're out when you're wrong.
Just to have a plan in advance, basically.
Yes. Mm-hmm. This is where I get in. This is where my stop loss is. This is the point where I would be wrong. And also you should have some type of plan of how you manage successful trades. If I have a gain of, 2 times the 10-day average true range, I will now move my stop from a stop loss to a break even. If I have a gain of 4 times the average true range, I will move my stop to 2 times the average true range profit. And in that way, you keep trailing the market and allowing profits to accumulate on successful positions.
Mm-hmm. So I think probably the big thing is that people know they have to backtest, but somehow they don't really do it, right?
Right.
Or something. Do you see people have trouble with backtesting sometimes?
So yeah, I wish I could tell you that don't worry about it, but I do think that it's worth, if you're going to put money in the market, you should be willing to learn basic programming. It's not the easiest thing in the world, but it's not rocket science either. Especially, I think a lot of these programs out there, like CQG, has a very kind of user-friendly programming language where you can program fairly easily. I think that what's it called? TradeStation, also fairly easy programming language to backtest and trade and backtest these things.
Yeah, and depending on the market you have different software, right? So like for Forex, Forex Tester too.
Yeah, see, I work with CQG, so that's the only one I'm really knowledgeable about. In the old days, I used to work with something called Athena Expert, but that was years and years ago. I've worked with CQG now for probably around 15 years. So, and it's really easy. It's still programming, but it's incredibly easy compared to like real programming like Java or C++ or something like that.
Yeah, for sure. And what is a sample you look for when you start to backtest?
Yeah, this is what really gets people. To determine that something's statistically significant, I want to see minimum 2,000 data points, 2,000 trades, in other words, and preferably between 10 and 50,000. Mm-hmm. And then I feel confident that I've actually got something.
Mm-hmm. So this if this is something you do with the script, then it's easier, right? But I don't see people doing it manually, though.
Well, it's really not that hard. With a good data vendor like CQG, you can do 30 years after you've programmed it. You could do 30 years. It runs very, very fast. And that's for one asset. And then you just use, you change the symbol, and now it's doing another asset for 30 years. So you could, once you do the programming, you could get in and out and backtest something, I would say probably in around 15 minutes.
Mm-hmm. Yeah, this is amazing.
And get that much data where you have, 10,000 data points, and you have some confidence that you actually have something.
But yeah, at the same time, like people kind of go away from backtesting. They don't want to do it. But at the same time, it's like the thing that's going to make you successful, right? It's like the thing that's going to make you like a casino, basically.
Well, here's the thing is that if you don't backtest when the losses come, what's going to give you the confidence?
Yeah, exactly. Then you're going to be stressed, for sure.
Yeah. Well, and not just that, you could end up giving up on a positive expectancy model. Right? Because you have no confidence, because you don't know that it's positive expectancy. Or even worse, you could throw money down the toilet on something that doesn't enjoy positive expectancy that you never should have been trading in the first place. And by doing the back testing, you would have learned that this thing doesn't work.
So would you say that everything, like the most important part would be discipline, or is there something else people have to master when they start to trade mechanically?
Yeah, without discipline, nothing's going to work. You have to have the discipline, because without discipline, you will not manage the risk. You will abandon a positive expectancy model. Everything starts with discipline. When people start trading, they think it's all about the model. That the model will give them perfect entries, perfect exits. They'll never have to worry about managing the risk. They don't even know that trader discipline is an issue because they think they'll always win. And the more you get acclimated to the reality of what trading is, the more you realize that the model is actually the least difficult part, and the more difficult part is risk management, and the most difficult part is the discipline.
Would you fit emotion into discipline, or is that another topic?
Yes.
Okay.
Emotion is discipline. Yeah, discipline to temper emotionalism. Yeah.
So you basically have the strategy and then discipline on the side, right? The two have to be combined.
Yes, that's right. Yeah, you have the strategy, which includes risk management, and then the discipline to adhere to the strategy, the discipline to adhere to the risk management protocols.
So I guess you work with a lot of people who do this, but what would be the first steps people have to take if they want to get with a system and then make sure they have the discipline?
So the first step is actually to get some type of software package and learn how to backtest in that software package and play around, develop positive expectancy models. Most of the things that you'll test won't enjoy positive expectancy. They'll lose a little, or they'll be successful, but they'll be so kind of clunky that you're never going to trade them in real time.
Okay, so it's really about finding a strategy like that. And do you have any advice on how people can decide what they want to trade?
So in the book, I do give some throwaway models, real simple stuff as kind of like starting points. Now, in terms of what people want to trade, so are we talking about asset classes, or what do you mean?
Yeah, I guess asset classes or different type of trades, like.
Yeah. So again, really, I just know futures and spot FX. Those are the asset classes that I'm most familiar with. But I think trading is trading. I think that if you develop something that's really good, it should work in anything. It should work in stocks, bonds, anything. And
so how do you develop that good system then? Would you start to read books and find strategies in books, or how do you go about it?
So in my book, I actually have a chapter where it's called, I forget what the chapter is, but it's something about models, and they're basic kind of what I call throwaways. They're stuff that actually does enjoy positive expectancy. That if you spent any time in research, you'd be able to create a more robust iteration of these same throwaways. It's called How to Use Trading Models. And I give a couple of throwaways, simple mechanical trading systems.
Could you give us an example of what that looks like?
Yeah, sure. So one of the simplest ideas that it's actually kind of a sneaky way of me proving that people that are lazy are going to be, building your next summer house. So what's the lazy thing that people say about markets and technical analysis? Well, when the RSI is above 70, you want to sell. When it's below 30, you want to buy. So I developed a model called RSI trend. RSI trend will buy when the 9-day RSI is above 65. And it will sell when the 9-day RSI is below 35. And it makes money. What is it? How does it exit? It's well, there's a couple of iterations of it in the book, but I think I'm trying to think. One of them is using a 10-day Donchian stop. Another one is using a 3-day Donchian stop. It's really a game of inches. It really doesn't matter. As long as you're getting in when the RSI tells you it's slightly overbought and you're managing the risk on the trades that don't work, it makes money. So it's exactly the opposite of what people think.
Yeah, but it makes total sense because you profit from the trend, right?
Mm-hmm.
It's clearly like trend trading, so it does make sense.
Yep. And people don't like it. People are very uncomfortable, and that's one of the things that really works in trading is when people are uncomfortable, they can't do it, and so there's lots of money to be had. You profit from discomfort. So if you can't be comfortable with the discomfort of a position, then trading's probably not for you.
Yeah, this is important though, because people think that trading is only about putting a trade, but it's about how you're going to feel when you put that trade, right?
Right. Well, especially because everyone thinks you're wrong. Everyone thinks it's moved too far. Oh, it can't keep moving like this, blah, blah, blah. And sometimes they're going to be right.
Totally, yeah.
Sometimes it is moved too far and that's okay. You're going to take a loss on that one. This type of simple trading system, I can look at the results here, but it's going to have less than 50% winners. Let's put it that way. So this one, I did a 3-day trailing stop on this RSI trend on the back test. So it only had like 3674 winners. In other words, around 37% wins. So you're going to have more losses. And that's fine because its average win is twice as big as its average loss.
That's important. You don't have to be right more often than you're wrong. Totally.
Right.
That's totally right. Yeah.
Yeah, and that's why you can't trade the money, because when you have this big outlier profit, you can't get out because you're saying, oh, this is too much money, it's going to go back, blah, 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 because those are the ones that are going to pay for all the small losers. If you cut off the profit tail, then you're shooting yourself in the foot.
And what is your trading style today?
So I trade multiple models. I trade a low volatility breakout, which is trend following kind of, but it's very short term. It tends to hold from around 2 to 10 days. And then I have a high volatility counter trend model. So it basically waits for volatility to get overdone and then looks for reversion to the mean with a very, very good risk management protocol in case we're wrong, because high volatility can always get higher. So that's kind of risky. But, everything's risky. So it's all about how you manage the risk. So those are there's iterations off of those two basic theories, but those are the two basic theories that are running the 1, 2, 3, 4 models that are in use right now.
But yeah, so what I see is that those models are not like contradicting themselves, right? They're like different, so you can trade in different markets, basically.
Sure, yeah. It's kind of like a radio button. Either volatility is high or volatility is low.
Yeah.
So yeah, no, they're not stepping on each other's toes.
Mm-hmm. Yeah, this is good. And tell us a little bit, what is your lifestyle today as a trader?
Well, I've never been one to like really care about, the big house, the flashy car. My lifestyle is I like to trade. I like to teach. I like to write, and that's my lifestyle. I sit around trading, teaching, writing, and now with this CTA that we've formed, I'm going to start really training some junior traders and take them on and teach them how to trade. And I've already started to do that, but I'm going to do a lot more of that.
Can we say that you have more freedom than you used to have?
Yeah, I guess so. Yeah.
Okay. You didn't look sure, so okay, it's interesting.
Well, the thing is that it's a 24-hour market, so it depends how you define freedom. So I do have to wake up at 5 o'clock in the morning when the ECB makes their rate announcement. So in many ways, the person who has a 9 to 5 job, they have a lot more freedom than I have on ECB days.
Yeah, okay.
In general, all the other hours of all the other days, I can always go for a walk in the park or, do a workout or whatever I want to do whenever I need to do it.
Mm-hmm. And as a future trader, let's say non-ECB days, what is your schedule exactly?
Well, it really does change with every day. So some days are kind of news heavy, and I have more screen time. And other days, and also some days I have more positions that I'm babysitting, and some days I have very few positions or no positions. And so my day, I try to do a lot of reading, and I try to do a lot of writing. As a general rule of thumb, I want to write. I want to do study and research.
So this is going to bring us to the next part, which is how can people find you if they want to read what you write?
Sure. So you can go to cnvcapital.com. That's our website.
cnvcapital.com. Cool.
Yeah. CNV, cyclical nature of volatility.
You're on social media as well, right?
Yeah, I am. Yeah.
Yeah.
Mm-hmm.
Cool. So what are your main goals for the future?
Well, I'd like the CTA to be, really successful. I think that we have a very aggressive soft close target of $5 billion because we're trading 26 incredibly liquid assets that have low correlations, and we're trading multiple models. So I think that our capacity is quite high. So I'd like to, I guess the first goal would be to get to 100 million in assets under management, and I think the ultimate goal would be to close the fund. Close the CTA. It's not a fund.
And what's keeping you motivated? Is it the passion for trading?
I think at this point, it's funny because I know people talk about passion and this and that. I think at this point, I look at it like passion sounds very emotional to me. I look at it like I'm a scientist, and I'm doing experiments in the market every day, and I never know, is this going to be a successful experiment or is this going to be an unsuccessful experiment? But overall, I know that it's positive expectancy models. We should see some success. So I look at it much more as kind of like, let's see what happens on this one.
But it's not as if you jump in the market without any plan, right? You still have everything planned. Yeah.
Everything is totally planned. There's no discretion.
So, Richard, I just want to remind the listeners that all the show notes are going to be on thisartoftrade.com for this podcast. So if people want to find the links we talked about, either about the software to backtest and everything, it's going to be on thisartoftrade.com, the link to your book as well, and all your sites. And Richard, I have one last question for you, which is, if you could give only one sentence of advice for traders, what would that one sentence of advice be?
Manage the risk.
It's simple. So how do you do that exactly?
Never risk more than 1% of assets under management on any specific trading idea, and dampen the risk in front of event risk days or event risk moments, and be cognizant of correlations between assets, positively correlated assets. Dampen your exposures because of that.
There's a lot in that. So, Richard Weissman, thanks a lot for being on the podcast. It's been a pleasure to have you here. And for all listeners, I'll see you in the next episode.
Okay, thanks a lot.
Alright guys, so how was that? I hope you liked it. Go on desiretotrade.com/group. Write your main takeaways from the podcast in the group. This is a great way to, first of all, remember it, and then help other people as well. Let me know if I can help. And go check out desiretotrade.com/new to see the new thing I've been working on. This is really gonna help. I have no doubt. So check this out, register if you want, and I'll see you in the next episode. Ciao.